All right, good evening, everybody, and welcome to tonight's webinar. It's Trade Management and Execution. My name is Mike Rotting. Now, before we get to the actual webinar, as usual, please take a moment to read the risk disclaimer. That should be long enough. All right. So we're going to cover actually quite a bit today. So I'll briefly introduce myself, and then we'll talk about types of trade execution we're going to do, right? So manual and pending and how you set those up. Then we're looking at how to find your entry and exit points so you can actually implement the trading execution styles. Then we're going to look at what trade management really implies, the way you can apply it. And then obviously we're going to go to LegacyFX MT5 and we're going to just apply a few things. I'll try to open a few trades if we can find one and open a few pending orders and stuff like that to see how you could set them up and tweak them and do some micromanagement on them in different ways of trade management. And then as usual, for those at the webinar live, after all of that theory, we're going to open up the Q&A where you guys get the floor and you can fire away. Having that said, let's get on to it. So about me, well, who am I? So my name is Mike Rotting. I am 36. I live in Athens in Greece with a wife and a wonderful daughter. I'm originally from the Netherlands. This is where I studied BTech, our International Business Studies, through a BTech system from Cambridge at Deltion. And it was during this period, a little bit later on in that period, where I rolled into the financial trading, and that matured into Forex. Now, like most of you, at start, not so good. Tried to find different ways to learn, different self-proclaimed gurus, fell in all the snake pits just like you guys did. Especially because I was young and stupid, listen to fairy tales. But eventually, 2 accounts later, I realized I should be doing things a little bit differently, maybe not, expect mountains. So I sat down and developed a system for myself and started really going dot by dot. And well, that brought me to what I do because, 10 plus years later, here I am, consistently profitable on a yearly basis. And, I help, apart from obviously doing webinars like this for now, in this case for Legacy. I also help traders with coaching, obviously try to pass on as much as I can of the knowledge to avoid, beginner mistakes mainly, because eventually everybody gets their own trading style, if you develop and guide them in that and help with that. And then on top of that, obviously, I am also in the process of studying for my credentials to become financial advisor. Obviously, a lot to do with offshore investments and stuff like that, but the whole spectrum is basically what I want to cover. So yeah, that is me in a nutshell. So now we actually got that out of the way. So let's talk about the different ways you can actually execute a trade. Most of you are going to know these, but we're going to skimp over them. So first of all, you have the manual execution style. Now, what manual execution style is means that if we go to a chart, and this seems happens to be, I'll put that to a 4-hour chart. This is the Euro-US dollar in 4 hours, completely blank, as you can see. There's 2 ways to manually execute a trade. You either have a new trade order, right? If you go to, where's trade? I used to have it here, but new order, there we go. So we go to a new order, and this is a sell by market or buy by market, which means you execute it at that point. And obviously you can here determine your volume, which is your lot size, right? So 0.01 is a micro lot. This just means depending on the leverage that you have in your account, this is on 1 to 100, obviously it becomes 1,000. You set your stop loss based on the level of this price on the side, and you have your take profit, which is again the same scale. So let's say here we would want to take a sell and we want to have a stop loss. We don't know where it goes, any of this goes yet. We're going to get back to that later when we start doing the trade execution, the entry points, the technical analysis to find our entry points. But then we can use these different ways of execution. Now, fill policy is not something you really should care about, but generally speaking, just do immediate or cancel. So it either immediately opens the trade or just abandons the trade for opening. This is if you have very, very high spikes, because if you do fill or kill, then it like just cancels the trade if it spikes out, but forget about that. Generally speaking, just open the trade. Nothing's going to happen. You can also do, this is your manual one. Now the second one, and this one is something that you have to be a bit more careful with because it remembers your last thing. This is called a one-click trade. I'm pretty sure most of you are familiar with this one, but basically instead of setting up your stop loss and you take profit first and then opening the trade, you literally just click sell and boom, it opens the trade. Now, when you do that, it does allow you to then set your stop loss and your take profit by just dragging and dropping, which when you are trading in a bigger time frame, like a day or 4 hours or an hour, this is the preferred method for most. However, always double check that you have the correct lot size set up before opening the trade. Okay, so this is obviously an important thing. Now, where's my trades? There we go. So when we open the trades, you will have your trade visible in your trading panel under trade. In this case, we just close it and boom, you have your trade closed. So this is as simple as it gets when it comes to a manual execution of your trade. Now, the other option that we have is obviously pending orders. Now, these have a little bit different. So there's a buy limit and a sell limit. So the way that it works is if I have my chart here and I right click, let's say here. So we have, I'm going to put this really fast. We're going to get back to this, don't worry. So let's say this is the previous high. I want to basically open a sell when it gets here. Well, if I right click the chart just above this point, you will see, oh, I clicked on the object. That's why. There we go. There is a sell limit. So when I click on that, it now puts in a pending order. Now what this does is very simple. If the market spikes up or hits this line, it automatically executes a trade. It automatically opens a sell for you. Whether you're looking at the chart or not, whether you're here or not, whether the computer's turned on, doesn't matter. That order is set for your account. Now what you can see is that when you right click on it or double click on it, you can modify the actual order. So this is the part where when you do a pending order, in this case, a sell limit, right? So a sell limit is when you do a pending order above market price, and a buy one is when you do it underneath market price, right? So you try to buy when it sells, you try to sell when it buys, right? Now, here there's a few more options, and this is important when you get a little bit more advanced. At the start, this is not going to be that important to you because you're not going to plan that far ahead. But let's say you see a trade that is developing and it might hit there in 3-4 days, but then 6 days after, you have the problem of it could potentially be that there's an economic event happening and you don't want that trade pending to still be there by then. If the trade is open, fine, but you don't want to have a pending order. So let's set that up. So the way that works is you have your pending order here, right? So we do a modify of the order. That's automatically where it sits to, by the way. This is your entry price. You can now change that. You can move it up or down. So let's say if I move it to 1.19, it will now move to 119. If I now go with my cursor on it, you can also drag it, by the way. Oh, where's 119? Oh, it doesn't accept 119. It's way too far out of range. So 118.5, let's say. So let's say for examples, 118.4. Why is it not moving? Oh, that's under the market. Christ. Okay, 118.490. We should see it move. Right, so if I click modify, boom, now it moves. There we go. Okay, so this is the simple entry point modification. Now you can already set your stop loss, which you will have calculated with your technical analysis. We're going to do a little bit later. We're going to go through the whole set. I'm going to run through it and then do both types of execution. So let's say you want to stop loss at 118.595, then you just do 118.595. And for your take profit, because we're looking at a sell, obviously, right, it needs to be, no, let's say the lowest one, so 118.100. Not 18,000, that'd be insane, but interesting. Now, here's the thing. You can actually specify a date and time that you want this order to be canceled automatically. So right now it's Thursday. Now let's say by Friday, I want this order to be done. So by Friday, by 9 o'clock, and this goes in 24-hour format. For most of you, it's not going to be a problem. This is not AM, PM, 24-hour format. So now tomorrow at 9, this order automatically removes itself from the trade. So it's not going to stay. It will automatically remove itself from the equation, right? So this helps you. It's important to do this. And the reason for that, especially if you're not wanting to have them open over the weekend in case you get nipped by a gap opening or something, what's important to understand is that if you don't do this, you have a risk of letting trades open and losing track of which ones you have open, even though you will find them in the bottom here, right? In your trade, what's this one? Oh, that is this one, right? So here is your trade, right? You have all your pending orders right here. Now, some people accidentally do this and then they don't know how to get that back. It's Control T for those that want to know. But if you're missing that and you drag it down like this, because you don't need to look at it all day, you can understand that you need to make sure that these pending orders don't stay and you go on a holiday or you forget about the chart and you walk away from the trade. And 3 weeks later, you come back and go like, oh shit, I still have that pending order. Now I have a stop loss in it because obviously the market's completely different, but you completely forgot about it, right? So put an expiry date on. Now, another thing is, once you have it set up in a certain way, you can just drag and drop it any way you want. So I can now say, okay, this is where I actually want it, but now I can see my stop losses. I want to be outside of those wicks, and my take profit's a bit too high, so I'm going to take the more stable one. There's my sell stop. So you can manually drag and drop and alter it that way, or you can go the long way and right click, modify, and then change them here manually one by one. But this is the only place where you can modify the expiration. Now, if you want to do it not by hour and just trade up by day, you just obviously do specify day. You just say what day and then modify, boom. Now, if it's not open by tomorrow, it closes. End of story. Stroke of midnight removes itself. Okay? So that's the two ways that you could potentially open a trade, right? We can manually do it, one click buy or market execution, or we can do a pending order, which is either buy limit or a sell limit. And obviously you can only do a sell limit above market price. You can only do a buy limit underneath market price. Now, before we can do any of those, well, we need to find our entry and exit points, right? Because executing a trade without knowing this is a bit of a problem. So let's do some technical analysis first. So the first step you do is do your technical drawing. Now, like I mentioned, there is a specific webinar on technical analysis, multiple parts. For those that are looking on the LegacyFX YouTube channel, just look it up and then you can go over. So I'm going to go through it fast. So in this case, what we're going to do is do our top down. And in this case, I want to take a look at a week. Forget about that line. I'm going to take a look at the week, and obviously we can clearly see a double top. I just want to have a clear overview right now. Okay, so this is the actual hard top right there. This hit wicks, we know that. Then we're going to look. There's another one here by the looks of it. Just quick switch here. Yep, there's 2 wicks. It's only 2 connection points, but obviously we're very high in the market, so that might explain why. And then I just want the bottom one, which is obviously this one. I think it's the most obvious one, which is where it just went. It shifted a little bit, but that's okay. All right, so trend-wise, we don't have a trend. There's no up, there's no down, because if we look at an uptrend, we start from here, we go there, that crossed through, so that's definitely not it. And from here, we can only say, well, we have like a little bit of a surface here. So for argument's sake, let's put this one in, and I only want to see this in weekly and higher. Weekly and lower, sorry. Now, let me change that to the same color as that other, whatever that is. I think that is like golden brown or something. Yeah, there you go. So we only have a top trend line. We don't really have a channel. We can look, however, here, and we will find out that these two bottoms actually do kind of line up with that top. So we're going to test that really fast by just saying, what if I slap an equidistant in there? Actually, that does match. And we can flatten out the curve and take the noise out, but then this doesn't match unless we put it on the wicks, which again, it matches. However, we know that we're more in a double top scenario, right? So from your technical analysis, you know you're going more sideways than you're in a trend, but it could be a developing trend. So in this case, we'll decide to take the wicks with us. Again, this is, you know, that case by case basis, and we just kind of tweak it a little bit till it like lines up a little bit good. There. This is only suggestive. We know that this is not a set trend. It's not developed yet. So it's just a suggestion. It's for us to have a little bit of a reference point to work with. So now we do our day. And in a day, we're just going to skip through. Let's see, the top, we don't need that. Let's see if there's anything in the middle that would make sense on a day. Well, there's these tops. There's these bottoms. I'm looking here and here. We go a little bit lower. There's a few points here. This is still a few days out, but let's grab that one. We'll make that blue. Boom. So let's do the next one. Obviously, we have the previous high. But is there something dead smack in the center of the day and the week? Because we don't want too many things all on top of each other, obviously. No. So this is the highest, which is more relevant to the week, most likely. Like, there's a small day resistance here, but you're also close to the week. So we care more about the week at the end of the week. So if it would be Friday, I wouldn't care about the day line. I would only look at the week line. Now, here we go. There's 1 point there. There's 2 points here. This is probably with wicks. Let's take a peek. And yeah, that one hits with a wick. So this is fairly good. We'll take that as a day as well. This is relevant for days. I mean, this is 1 day up, 1 day down, unless it spikes, obviously. And then we have this, but this is more relevant to the week. So we'll leave that one out. This is good enough for the day here. So now let's switch to an hour. And what do we see in an hour? In an hour, we had a bit of a downtrend right there. That doesn't really line up with anything, but we have this as a channel, as a suggestive channel. Again, when you're doing things like in smaller time frames, like an hour, it's more suggestive than hard written, right? Bigger time frames overrule small time frames. I think everybody knows that. Right, so if you don't, there you go. Bigger time frames overrule the small ones. So now we go again, we make this clean. Let's take a look. Well, if we put the line here, it matches with this and this, but we're so close to the day, it doesn't matter. So there's no point in putting a 1 hour line in there when we already have the day there. So let's go down a little bit more. Most of you already saw it there. Well, here we have 1, 2, 3, and this is also with wicks most likely. Let's take a look. Boom. 1, 2, 3. So there, that's a clean line to go with. So go back to this. No, not that clean. Obviously, we have quite a few things here that it just broke through, but that might be relevant again later because now it's trying to push up, so it might become a resistance. So let's keep it for now. And then the most obvious one is obviously the bottom, but look how tight that is to this one. It's probably more relevant to then keep the bottom one instead of this top one, because this could be a smaller time frame, it could be something else. Like you can keep them both in if you want. Like you can look here, you have 1, 2 connection points, but then you have this peak through it, so it's not that clean. So I would go with this. This is pretty solid. Go to this, there's a bunch of wicks. It's solid with this bottom where it got stuck underneath it for a little bit. So I would go, this is your setup. So now that we've done our technical analysis, at least our trend support and resistance, now we need to add our indicators. We don't need our indicators to identify where the entry points are, but let's say you do all of that and you end up with this. Right, so I color coded it and made it only visible in certain hours, etc., etc. Nope, that's 4 hours, so I need an hour. There you go. Right, so that was here. What was it? Here. All right, so now we have everything set up the way we want it. Now the question is, what are we looking at? We have our indicators implemented here, and now we can actually read what the market's doing. Now this is on an hour, so let's take a look at the 4 hour or the week first, right? Top down. So in the week, we can see obviously it's moving sort of sideways, but slowly developing a lower down, even though it was going up first. But obviously this line, so this potential line was broken. It quite clearly closed outside of that line. So that's why we have this latest suggestive trend that maybe would be developing. And for a double top and a head and shoulders and all that kind of stuff, that would be indicative that this is going to go flat and then start to accelerate back down to somewhere here. Hypothesis. But what do our indicators say? So right now we're in the bottom of the trend, probably moving up, which is exactly what our indicators say. We have pressure downwards, but we're turning upside. We have the pressure starting to go up, which is what is reflected here as well. This trend carries on in the day, except for the stochastic in this case, where we know that it just turned off. For those that were with me in the webinar 2 weeks ago, we actually stood a pending order right here. Whoever had that, good luck, you're flying. So this is bouncing off the 50 line and going up. This volume just switched from sell to buy. And if you look, it switched from sell to buy right there. You might think, okay, but it went down from there. Yeah, because we are expecting it to do that in this sort of time frame. But we do expect it to basically go up because here it just turned. It will most likely go further down as the week indicates, but we know it wants to go up. And by our indicators, we know that right now there's more pressure down than up. So we want to basically get a nice trade against the trend in this case. And that will be more relevant for us later when we discuss risk management. In an hour, we see that there's pressure up, which makes sense because in the week, we know it wants to go here. In a day, we know it wants to do like this, right? Down, up. And that would correspond with this being going up and then back down and then something like that. So if we squash it a little bit, that's where the day is. That's where the trend line is. So it's quite a bit of distance. And you see it flatten out here for the last few hours, which means that I'll probably do this, and then go up. Something along those lines. It could also obviously just burst into here, right? Different scenarios. We'll get back to that in a minute. So how do we read our entry points? Okay, so the ideal entry points would be, well, whenever we get back to the top, there's quite literally a double top there on the day. So there's two possible entries. I can take a sell here, even though we have more pressure up right now than down, even though we have a developing long-term downtrend. Sorry about that. In the week, we know it wants to go up. So we want to buy. But at the same time, right now, short term, we want to sell, right? Because this is probably going to go up a little bit and then pull back down as it has been. So what do we do? Even though it's a bit undecided right now, if you'd have to make a choice, what would it be? This is where the Q&A is, your guys. Based on all the information we looked at, week is a trend down. The day wants to push up a little bit, but on the 1 hour, we see the same thing. It wants to push up a little bit right now. What would you do? What are the two options we have? Obviously, we have a buy and a sell option, but how could we implement those if you look at a time frame? Yep. So Wayne nailed it. We could set up a sell limit. Right? We know it wants to push up, but we don't really want to trade against a trend, especially when it's like only developing. So what we would rather do is set up a sell limit. But where do we set up the sell limit? Do we set it up at 0.1? Let me just put the text in. So here, What is this? Point A, or 1. So do we set it up here on just above this line? Do we want to take a cell limit here? Or do we want to set it up somewhere over here? One, 2, or 3. Where would you put your cell limit? This is a day chart, by the way. I'll go through them on the hour chart as well, so you have an idea where they are. Oh, they don't visualize here. Why not? That's new. Do I need to change the visualization? No, it's all time frame, so it should be there. Odd. So in a week, it looks like this. 1, 2, or 3. Where would you set up your cell? Who's going to take this one? Oh, there it is. Oh, it's just off screen for 1 hour. Okay. Thank you for participating, Win. Yeah. So one good point is exactly, you want to set up your cell limit at 0.3. Now, the reason we say 0.3, you might think that's like 4 weeks away, 5 weeks away. Yeah, but it's fine. But we prefer not to trade against the trend. Patience is what we want. Right now, you can say, well, there's no point in setting it up now because everything can change by then. Sure, but it can also jump up in 2 days. Now, the ideal entry is 0.3. That doesn't mean you have to wait till it gets to 0.3. We just want to make sure we initiate a sell when it gets somewhere around this level. Now, if we take the average angle into account, whoops, I didn't want to move that one. Where did that one come from? I just drew that one, didn't I? There you go. That one I needed. So let's see. This went up at this angle. This went up at similar angle. So if this would go up at the same angle, basically where it hits the eye. So basically where my line is actually perfect. Like right dead smack in the center. You don't want to go too high. You don't want to go too low. Because from our sell limit, we already know that if I initiate the trade anywhere here, where would my stop loss go? What my stop loss go at? Here we go again. Me with the boring points. 0.1, 0.2. This one is a little. Okay, can we? Thank you. 0.3. A little bit higher. And put that one over there. So we've determined our entry point. It's somewhere over here. Would my stop loss be 0.1, just outside of this line, 0.2, or 0.3? Come on, somebody give me this one. It's a little mean, but you are on fire, Wayne. And then David, yeah, you got it too. Yeah, thank you guys. Yeah, last swing high point, right? 0.2. Now, you want to fine tune that a little bit. So let's say we open our trade in 0.2 and we see that 0.2 is dead smack in the 2 wicks. So you want to move it up a little bit. Now, if you wanted to go super safe, you can move it out of here. This is still not 0.3. It's more like 0.2.5. That's fine, right? But basically, generally, you want to clear this wick. Now, I don't expect it to go back to the wick because that's a previous high. It should only go here and wick there and then go down, right? If it creates a new double top, which probably won't. But even if it goes here and then creates a body and a wick, it should basically never go to 0.2 because in order to go to 0.2, your trade would have to break both the trend and the resistance in order to get there. So let's take 0.2 here, 0.2.5. We can remove 0.3 and we can move. Okay, that doesn't work. 0.1, come on. No, okay. Oh, come on. It's having a joke. It's having a laugh with me. There we go. Now, so our entry was here. based on that angle that we had that I deleted, that I need to draw again, something like this. Yeah. All right. So right here, that's our angle. Now, 0.2 means that if that's our stop loss, where is our take profit going to be? Well, we do the same thing as we did with this line. Now, obviously, this is not set in stone. You can have a drop like this, or you can have it that it just stagnates for a while. But in general, if you would pull from top to bottom, you will get an idea that usually they kind of line up. This one had a little bit slower. So this one went here. So if this one is here, the other one was here. If you take the average, that's something like this. So we take that as an entry point. Oh, look at that. That perfectly lines up with the resistance. So yeah, this would be a no-brainer. That's where you slap in your take profit. So now we found our entry point for our sell. Now hold on, I'm going to get back to this. More importantly, I'm going to get back to what we can do in the meantime, because this is obviously a few weeks away. But this would be the ideal entry point for the long-term trade that is safe, that's most likely in line of the trend, because obviously whatever this was is long dead. This is also dead. So there's very little chance that this is going to continue up. I'm not saying it can. We have other factors to consider. But based on technical analysis, we would say this is where it's a good entry to go in for a sell. And when we look at our stop loss take profit ratio now, that's a 200 pip stop loss. That's a 500 pip take profit. Now, some of you are going to go like, holy crap, that's huge as a stop loss. Is it though? 20 bucks. Now, unless you have a $500 account, 20 bucks should be an acceptable risk level based on a percentage of your account. Because if you have a $1,000 account, 20 bucks is 2%. And that would be with the trend. We're going to get back to that in a second. We're going to discuss lot sizes real fast. So in this scenario, I will say I have a $1,000 trade, a $1,000 account. If I want to take a maximum of 3% risk on this account, we can now set up our trade. And we're going to do that later when we put everything in practice after we discuss risk. And then we're going to set up this trade. Now, in the meantime, you can just still do your day trades. You can still do your intraday trades until you get there. This is your active trades. This is your pending order. This is your, okay, in a few weeks, we're probably going to get there. And when we get there, this analysis is probably not going to change. Because unless there's a fundamental reason for something to change, it'll just repeat the pattern and it'll just keep going. So these are the consistent ones. Now, we also already predicted where the market's going to go. So every time it gets low, I want to buy and micromanage the trade. Okay, so we have one entry here. So then that naturally says that the next entry would probably be somewhere here, which is my buy to go there. Or every time that it curves down, because this is an hour, it could be that the hour starts developing as a trend like this. Right? Every time it bounces off of this, go back down, I take a buy, back up, close it. And then when I get close to this, I just leave. I don't take a buy, obviously. This is how you could trade against a trend. So this would be manual execution. Okay. Now, in the same note, you can already plan ahead, if you're really ballsy, is take a buy limit when you get to the bottom of your take profit, where you automatically close your sell and take your buy. But obviously, this is a very long-term trade, right? This is a trade that would run for several weeks. For most of you, not going to be a trade you're going to be doing. Right? It's like 8 weeks, something like that. So that would be more like a swing trade, some of you are going to say. For those that do day trading, this is still relevant to you because you can understand that this is your line that you're going to be trading with on the short time frame. You're going to be trading around that line. Every time it's under, you buy. Every time it's over, you sell. And you just follow the wave down because this is going to be a trend for a few days. Right? So that's how you can make it relevant to your smaller time frame. But understand the big picture so you can trade the small picture. Okay? So we've now done a technical analysis. We add our indicators. And from that, we judge a little bit where the entry and exit is going to be on our options. Now let's take a look at the fundamental analysis, because that's one point that we didn't do. And one of those things is you just literally go to Trading Tools, Economic Calendar, and boom, you have your fundamental analysis. Now, again, there's a different webinar on fundamental analysis, how to read this, how to predict it, and everything else. However, for now, what's important to understand is that if you're going to manually execute a trade, let's say right now, I want to take a buy because I think it's going to go here. Will be a terrible take profit stop loss ratio, but forget about that for a second. Let's say I want to buy right now. I'd be an idiot if there's a trade, if there's an announcement in half an hour and I open a trade now. And trust me, I know that some of you have done that. This is going to sound familiar to some. Like I opened a trade, I completely forgot about the economic, and the NFP came out, completely forgot the NFP was there. I've had that one happen a few times to a few people of mine. Like that you forget the big ones is one thing, but the small ones also count. They can kind of distort or slow down your trade, right? So look at the economic calendar before you trade, before you open the actual trade, because you need to predict whether or not there's going to be interference in your trading pattern. So if we again look at this and we take the average here, I'm going to zoom in a little bit. Sorry if I slow down a little bit because I need to move the chat things around. This went down at this angle. This went down at this angle, but just continued longer. This one went obviously in a sharp. It's not really down. It's more like a consolidation phase. So the last time it did that and went up, let's take a look at the up angle. So in case it does go up, that's that one. Now I need to stop these two things. So up seems to be a lot slower. Like it might spike, but it goes a lot slower in general. Right here, it like dumped, then it spiked, and then from even with the spike in that, this is the average, which is the same here, from flat to up. So you see the pattern here, right? Flat, spike up, flat, up, down, flat, spike up, flat, up. Anybody notice anything? Read the chart. They tell you what's going to happen. So here, it's much longer, much slower. But if we are going up right now with our, well, look at this. It did the up, it did the flat, did the up, down. So now it should do its up thing. But if it adheres to that average angle, it should be something like this, right? So from here, if I press Control F, which is your little measurement thing, it's your crosshair, that one. When you now measure that line, let's say I take a buy to here. Again, don't do this, but you get not only the price, you also get something like 13 bars. Does anybody understand what those 13 bars mean in a 1 hour chart? Come on, blind guess. Yes, thank you, David. Yeah, obviously, 13 hours. It's 13 1 hour bars. So if I'm in 4 hours, well, it's, and I calculated here, it's 3 bars. Well, 3 times 4 is 12. Right? If I do it in a day, well, it says that should be 1 bar, 90 pips. Should be 1 bar. Worth, well, 3 bars if I go like this, 2 bars if I go straight up. Right? So about 2 days. Right? So now you have a rough time frame in how long this trade should roughly last if it follows roughly the average it's been doing. Right? So this is how you can plan ahead a little bit. So now you know, let's say the trade takes the next 10 hours. Check the economic calendar. Is there an announcement in the next 10 hours? And let's say it slows down for whatever reason, too many pending orders, there's a price point or supply demand zone or whatever. Let's take a look at it. Forget about those things for now. Is there anything in the next 24 hours that could interfere with my trade? Because remember, the start is the only risky point. Once the trade is open and once it starts to develop, you know what the trade is doing. At the start, you don't. At the start, it's literally on that line, a little bit under it because of the spread. But then that's where if you get a negative one, it can just spike down, hit your stop loss, and then recover, pull back if it's against the trend, pull back, and then go with the trend as you thought it was going to do, and then hit your take profit. And this is where you got those scenarios where people say, well, the trade got knocked out to my stop loss, and then it went to my take profit anyway, so it was a good trade. Yeah, the direction was good. Your execution was just bad because you didn't plan ahead. You didn't factor in like, oh, what if that happens? right? So there's a lot of little bits and bobs that accumulate together. It's all these little small dots on the I that change it from you're randomly guessing to, hey, we're actually trading. Now, the last one is calculating the ADR. Now, there's a reason I'm telling you how to do this, and we're going to get back to that later. It has to do with trailing stops. But the average daily ratio is very simple if you just look at what is the average candle length for the last few days. Now, usually you take a trading week, so 5 days. Right now it's Thursday, so it's the last 4 days. What's for the week? We're in a down week. But let's say I would open the trade now. I have a sell here. How would I factor in my ratio? Well, you just take a look at what the last time that it sold, what is the average ratio for, like, say, 5, 6 days. So here the range is 60. Here the range is 40. Here the range is 40. Here the range is 50. Here the range is 30. That one's the big one, 60. So we're between 30 on the low end, 60 on the high end. So on average, roughly 40, 45. If we take at least wicks and ranges in between. Now, recently with the ups, let's go back a few days. The down ones are 46, 47, 34, the up one, 42. Now these are all dead. 45, 45, 50, 26, 54, 35. So again, low end is like 25, the high end is like 60. So it's pretty safe to say that if you're trading the euro US dollar at the moment, the average daily range is about 40 pips, 45. It might shoot over to 60, it might shoot down. Right? That's all you do. That is literally it. Right? But it's important to note because a lot of people actually don't do that. I don't know why. But it's going to become relevant when we do this. So trade management. So what actually is trade management? There's different stages. All right, and we're going to get back to that before and while the trade is open and after the trade. But one key corner point to everything you do with trade management is your risk management. Now, risk management, I'm not going to go in full. Again, that's a separate webinar on its own. But one thing I want to do about is lot sizes. Please don't trade with a fixed lot size. You cannot have a profitable trading account in the long run because you're basically doing a linear equation. So if you have 10 losses, you're going to have 10 wins and you're going to still be to zero. But if you do a percentage-based system, your 100% changes every time. Ergo, your growth is exponential and your losing streaks become smaller because you're cutting down the amount of risk you can take per trade. So you're flattening the curve while you're accelerating the curve upwards. So recovery is faster. I have a long Excel list that I can show, but we're not going to do that now. Now, how do you calculate a lot size? I touched on that a little bit. So let's go back to our 1 hour. Where's our trade? This is our trade, isn't it? Where's 1 hour trade? Where do we execute it? 4 hours, day. Oh, no, in a week, right? Yeah, okay, week. There we go. So let's take our week pending sell order. Now, I know where my entry point is going to be. I've determined that this is going to be my entry point, and this is going to be my stop loss, and this is going to be my take profit. Now, the point from entry to take profit, I could not care less. I've never heard anybody complain about more money. I have heard people complain about losing money. So this is the only side we're actually trying to control. I'm pretty sure most of you are going to agree with me on that one. Now, we know our entry, we know our stop loss, so let's measure it. Okay, 182, well, 1,821 points, but for ease, that's 182 pips. Okay, so let's take a scenario. This is where you guys need to count. I have a $1,000 account, and I want to risk a maximum of 3% on any trade that goes with the trend, which is what the sell would be, if this trend is indeed correct. But let's assume it is. So let's take a 3% risk on $1,000 with 180 pip stop loss. First of all, 3% of 1,000 is 30. Now it could be $30, 30 pounds, I don't care. That doesn't matter. 30. Now our stop loss is 185 pips for ease. So you do it very simple. If I have a mini lot, that makes it $185. That is way more than 30, obviously. But if I cut that by a tenth, so I go to a micro lot, I'm only using $18. So even on $1,000 account, you can take a big weak trade like this, but you would be able to take it on 0.02 lots, 2 micro lots, and you would risk $36 total, or 36 pounds or euros, whatever your account is, right? Now that is slightly more than your 2%, 2.1, but it should be, or 2.2, which should be acceptable. Right, it's the closest you're going to get to getting a little bit more out. So you also understand that if my entry point is even better, if I put it here, let's say I pick this my pending order, now my stop loss is only 130 pips. Notice that the stop loss doesn't change, the take profit doesn't change, but only my entry point, which means that if I get closer to my stop loss, which remains the same safe spot here, it's outside of trend, outside of resistance. So it literally needs to break both. So it basically needs to break out in order to get there. And it's above the previous high swing. Doesn't really look like it, but if we zoom in, it's clear of this point. Not by much, but it doesn't need to be by much. Okay, so if we go in here, let's see what that happens to my calculation. Now it's 150. So in this case, it will still be 0.02, but you would just go to 30 risk instead of 36. But the funny thing is this side, because in my original, which is over here, we're risking 36 2 times 500, so 100. Am I saying that right? Yeah, so I'm risking $30 to make $100. But when I have a little bit better entry, so I tweak it even a little bit more, and I now have that 0.2 as well, I gained that here. So now I make 100 and, what is that, 110. So I candy 10% more. You know, I nibble 10% more trade while reducing my risk by 20%. I lose 6 on 30, so about 20% less risk. But the original, so this is more important when you're doing small time frame trading. So when you're doing like 4 hours or an hour, because then this differs massively, right? Let me give you an example here. Let's say we went in here, and your stop loss is going to be obviously outside of this wick and outside of that resistance. So that's your stop loss, and then your take profit is going to be probably that, right? A little bit less. Risk reward ratio wine, we're Gucci, right? It's at least 1 to 2, preferably 1 to 3 or more. Here we have 1 to 3, I think. That's 14. That's 40. So yeah, 1 to 3, 1 to 3.5. So we're good there. Now let's see what the difference is. So here I go in, we'll do the same equation, all right? So here's a 14 pip stop loss. I have $1,000 and I want to risk a maximum of 3% on this trade, right? If it's against a trend, you would do half, but let's forget about that for now. So let's take a 3% risk. So again, 30. So now I can take this trade on 2 mini lots on a $1,000 account. And I'm only risking 3% of my capital. And my take profit is going to be, in this case, $40 to $80. So I'm making $80 on this trade just because I have a good entry. But what happens if I had a pending order just literally on that line? My stop loss would have been the same. My take profit would have been the same. And watch what happens. I now only have a very, very small 6 pip stop loss, which is very, very small if you can factor in, you know, spread. So I would probably give it a little bit more room in that case, but let's say this. That's not a whole lot more. It's like 2 more. So it's 7 pips. Just to clear this a little bit more. But okay, let's forget about that. So we have a pending order right here. We have our 7 pip stop loss. What does our calculation become now? It's like 0.32, right? 3.2 mini lots, which is like we literally almost doubled it. But look what happens when you go this way around. So now, by risking the same 3% of my account, so it's the same $30 that I'm risking, right? Same 3%. Except now, the other way up. Why is it doing that? Stop it. Same way up, I'm now making 45 pips. Right, we gain that there. So we gain 7 there. But those 7 have way more value than the previous calculation. Because now we're doing times 3.2, so let's say times 3 for ease, right? We're making 135 euros on a $1,000 account in a single trade. That's pretty decent. I risk 3% to make 13. I don't know about you guys, but that sounds okay with me. And this trade is calculated within the risk margin of the smaller time frame. Ideally, I would want my original stop loss take profit to be outside of here because a day trade, so it could go there. But we're talking about a very short time frame trade, right? This is like 6 hours or something. A 9-hour trade, right? You could even say like this. We have a pending order there. Then you're back to the original 14. So, right, play with that a little bit. There's no perfect answer, but use your brain, right? Go outside of Wix at least. This is quite a while ago, right? Right, so that's how you calculate your lot size. Risk and reward ratio, so I touched on it, at least 1 to 2. So if you're risking 30 pips, let's say, you want to have at least a take profit of 60. Don't forcibly just set the take profit to 60 if your take profit stop loss is 30. Let the chart tell you where it goes, right? If I would execute the trade right now here, right, my stop loss is still going to be here, and my take profit is still going to be here. This would be the example of a bad trade. I'm gaining to 21 pips and I'm risking 34. I'm risking way more than I'm willing to make. So what do a lot of people do? They start doing this kind of nilly-willy stuff. I'll take like a 10 pip stop loss just in case it goes there. Who just went like, that sounds familiar? Don't be shy, I'm not going to call you up. I know this sounds familiar to some of you. There is a way that you can utilize this idea, but not in this, right? So this is like, don't force trades to be what you want them to be. The chart tells you what they should be. Like this one could be ambitious from blue to blue. But if I do that, see? Yeah, it's an inverted ratio. Like this is 1 to 3 inverted. So again, bad trade. So in other words, I cannot take that trade now. I needed to go down to take a buy, or I needed to go up to take a sell. Right now, don't execute a trade. Even if this trade would be a sell right now, even if it goes down here, right? Your stop loss would be here. Your take profit would be here. This is a terrible trade. It's like 1 to 1. It's actually slightly less. It's like 1 to 0.9, something like that. Right? So this is just a bad trade. And then you start doing things like, oh, well, I'll put my stop loss just above the previous high. Yeah, but again, look at the range. This is a resistance. This is the support. This is the resistance. What is it going to do? Like it can freely move in between this. So it's going to hit your stop loss whenever it feels like it. It can do that in the next 10 minutes. Right? It needs to have a reason to hit your stop loss. It needs to get through certain things. And then there's exposure. So exposure is one of the things what I see a lot where people's like, oh man, I had this amazing trade. Look. I had Euro US dollar, I had Euro GBP, I had the Euro CHF, and I also had the, because I wanted to change it up a little bit, I had US dollar to the CHF. It's like, right, so you have 2 on the US, 2 on the CHF, and literally everything else is on Euro. And all the Euros are buy or sell, usually, right? you're now overexposed because almost all your risk is in euro. You're literally spread over 3 different currencies, right? So you have 7 trades, but let's say it's 10 trades, and 50% of your exposure is to euro. That's terrible portfolio management. Now, for a small account, you generally don't have the luxury of being able to open 10 trades. Even with 3% risk per trade, which is only 30% of your capital, listen to me, guys, 30% of your entire capital at risk at any given time with 10 trades open at once. And you're all worried about having 2 trades open at once or 3. When you have this, with those 10 trades open, you're only risking 30% of your account. But now it's important to make sure that you don't overexpose. So generally, rule of thumb, I say 2 of each. If you have 2 euros, then it needs to be 2 other things in return for it. And then there's more advanced, you can do some natural hedging or counter hedging with some, correlated pairs and things like that have slightly different ratios, etc. But that is something we're not going to cover now. What we will cover is active versus passive trade management. Now, it's very simple, right? This is where we start speeding up a little bit. Active management is literally just you sitting in front of your computer, having this open and just monitoring everything, monitoring everything that's going on and making adjustments accordingly. Now, for most of the beginners, it is a terrible idea to start moving stop losses and take profits or adding trades to existing trades, double down and triple down and quadruple. Like, most of you don't have the necessary understanding of how to manipulate your trades correctly until much later down the line. And don't understand this in the wrong way. This took me years to even get anywhere close to right. And even then, you still occasionally screw it up. It is really, really tricky to do. What I teach most is a passive approach, but manually is literally just, okay, the trade is now at 45% into take profit. I move my stop loss. The trade is now 35% into down draw. That is okay. There's a news announcement in 20 minutes. Okay, I'll give it a little bit more berth and manually close it if it reaches a certain undesirable level and have the rate trigger ready and I'm trading on this window because I want to monitor everything at once. This is a lot of work and this will get you bald fast. Don't. Unless you actually have the time to sit down and do nothing but trade for 12 hours a day, drink way too much coffee, lose a bunch of hair, and have a woman yelling at you. This is more for what it looks like if you're actually doing this as day trading. And that's all you do. Was a fun 2 years, I'll tell you that much. Would not recommend. Anyway, having that said, what do we do else? Oh, wait, that's our chart. What is the passive way? So the passive way is actually quite simple, and this is why I told you how to calculate your ADR. So let's take our scenario again, where we take our day trade. And where did our entry point go? Oh, it's right there. So we did a week. So here, and ADR, you can also do it on a week. So here the week is, let's say, 100, 120, 120, 100, 100, 100, 100. I would say it's roughly 100. Not sure. Don't quote me on that. But you understand the point, right? On average, your US dollar moves about 100 pips a day. So imagine, just think about that for day traders, the ones that say that they're day traders. It means that if you would open the trade perfectly at the start of the day, you can make about 100 pips if you let it run for the full day. You can do 10 times that if you trade all the zigzags, right? Zigzag trading. But again, really, really time intensive, a lot of risk because you have to be fast on your feet. You have to read the market perfectly, and it's hard to recover because you're going so fast paced. So this is for way, 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 way down the line. If you even want to have a juggle like that. The way I teach is basically like, be on the beach with a cigar and not care. we have our average daily range is about 100 pips, which means in the trading system, it's calculated as points. Now, why am I pointing that out? Let's actually set this trade up. I want to sell limit. Oh, wait, no, I made a mistake. See? What didn't we do? I forgot to calculate lot size. What was the lot size? What did we say for this? 0.02, right? Can we change this afterwards? The answer is yes, by the way. It should, but it doesn't. Right. So we change it here first. No, 2.2. There we go. So now it should tell me, yeah, there we go, 0.02. That's our trade. No, I don't want to move the entry point. What am I doing wrong? There we go, 1.23575. Modify. Stop loss, it's a sell. 1.23575. Take profit. It's right here on our red line that we calculated, 1.16733. Good. Expiration. Let's specify it tomorrow because I don't want to. Actually, I want to be more specified. I want to be tomorrow before market closure. So, well, let's say 10. If by 10 o'clock it hasn't opened yet, obviously it's not going to because this is literally weeks ahead. But bear with me here for a second. Boom. Now, we take these lines out because we don't need them anymore. There's our beautiful trade. Now, anybody have any idea what else we can do here? Why would I calculate the average daily range? Who wants to take this one? We're slowly going over the time, so we're going to have to speed it up a little bit. The answer is trailing stop. This is the lazy way. Now, with some brokers, it works differently, but with this broker, thank you, Edgar. Yeah, you nailed it. So with LegacyFX and MT5, when you set up a trailing stop, it works from the moment it reaches the profit point in the trade. So not, in some platforms, when you set a trailing stop, it will immediately be active the second you open the trade. So the stop loss will start moving from the moment you open it. Now, obviously, we're all trading with LegacyFX, and if you're not, you should. So trailing stop, custom, because it only goes to 55 points. Remember, points is not pips. Pips is a tenth of this. So just take the last digit off. 5 pips is not a trailing stop. That's suicide. Custom. We did the average daily rating. In this case, the average weekly rating, but okay. We calculated 110 pips. So basically, we want it to be a little bit outside of that range. That means that if the take profit is in a certain amount of pips into profit, it automatically moves our stop loss to 0 and then moves with the trade. And it should only hit it if it pulls back more than the average range. So take the average range, which we calculated 110 pips, and add about 20 to 30%. I'll leave it up to you what you feel comfortable with. Play with it. Some things move a little bit more than others. You'll see that some are a little bit more volatile in their daily range than others, so you take a little bit more, the other one's a little bit less. Like the euro we saw is very strict, where we would take 30. This one was literally flat 100 every single time in the week. So on the week, which is euro US dollar, but we'll take the week, which is more stable. So let's take 20% more. So we'll do 130 pips, right? Or 135 freeze. So that's 135 with an extra digit, 0. 1,350 points. Okay. Now, when we look at this trade, you'll see a completely different picture. It should have trail. It doesn't say trail. Oh, I think you can add that. Trailing stop. Oh, it doesn't. No, you can only. Yeah, you can set it up here too by just clicking and then trailing stop in case you can't find the line. But so we know the trailing stop is active here now. what this means is that once this trade is executed, and once it is right here in profit, this will automatically go. It won't allow me to do it now. It will automatically move to your entry point and then move with the trade. So as the trade develops, the trade will go back. Now you think about, but what if it pulls back a little bit? We just calculated the average pullback. It should pull back more than an average week in order to hit your trailing stop. So it should just continue onward, unless there's 2 or 3 weeks pulling back. In that case, you'll just get a re-entry point. But this is the safest bet because most of you are not going to be in front of the PC or the laptop. Please don't say phone, but you'll be at work. You'll be in a meeting. You'll be in an airplane, whatever it may be. You're not here monitoring your trade. So let it do it this way. Yes, it's not optimal. Yes, it's not as good as manually micromanaging every single trade, every single step of the way. However, it will severely help you with avoiding those unnecessary green trades that end up red because you weren't there. Like, oh, it was green this morning. I came home and it was a stop loss. What the hell happened? Remember, if you go out at zero, you didn't lose money. All you lost was a little bit of time. And in the end of the day, what you're trying to prevent is loss, not profits. How many times have you thought, oh no, it went out on my stop loss when I moved it to zero and it went out at zero and then it went to my take profit? For your feeling, it's going to be like every single time you do that. But when you backtest it, the reality is if you wouldn't move that, because every time you didn't do that, count all the red ones. I can guarantee you they outweigh the green ones. So this is just an easy way to do the lazy way of micromanagement. And like I said, no, it's not the ideal way. People that are more advanced know that there's different ways to do this by manually intervening with different rule sets, right? Do a counter hedge during the volatile moment, et cetera, But for the mainstream, John, just do this and it will save you a bunch of money and trades. It has for me. So that's active versus passive, really. Now, we already discussed a little bit about trade management before the trade opens, right? So before the trade opens, you do your risk management, you do your analysis, you do the fundamentals, and you plan ahead. That's the ones that go but before. The ones that go while the trade is open is monitoring of your trades. Don't mess with your stop losses because I've seen that too many times. Oh, well, it's moving too much in the down draw. I'll just move the stop loss a little bit because I know it's going to turn. Yeah, no, just let it hit your stop loss. You had it wrong. It cost you some money. Move on. Because every time you keep moving it and moving it, you're just making the risk bigger and bigger and bigger. The profit isn't getting bigger. You're just trying to fool yourself until you get to a scenario where I had one guy once come to me who had moved it so much. We were literally 10 years into the trade and the trade was still open. Don't worry, the euro US dollar will recover to 180. No, it freaking won't. Seriously, that was his entry, like 163 or something for a buy. It's probably still open now. This is called marrying your position. This is really, really bad behavior, and we have it a lot when we're starting. Me, no exception. I did that too, right? I was confident in my trades, like super, super confident in my trades, which is what cost me my first 2 accounts, but that's beside the point. The thing is that you need to understand that marrying your position just means that you won't let go. Now, generally closing a trade, you need to think about it this way. Let's say we took the sell here, right? And let's say it didn't go that low. Let's say it only went to here where we are now. So that means our stop loss is going to be somewhere over here. All right. So now you're thinking, okay, so should I manually close this trade or should I keep it? So here's the answer to that. If the pullback is more than the amount you're trying to gain, the answer is yes, close it. Because you are now risking more of your profit backwards than forwards. Right? If you're trying to gain $20 by risking $50, it's the same as the 1-to-2 risk ratio when you originally opened the trade. You're now trying to you're risking more money than you're trying to make. This is just a bad decision. In general, you don't want to touch your trade, but once it's developed and it's been going, so in let's say this case, it's been going like this. Right now we're here. It's okay to say like, okay, now I see that there's a flat line here, right? So on the week, there's a flat line. So let's say we're over here and it just missed your take profit over here. Let's say it was over here or something. It's okay to say like, okay, my entry is here, my stop loss, or my entry is here, my stop loss is now green, it's somewhere over here. Well, let's say it's here. Then like if this is the current market and my stop loss, my trailing stop is over here right now, my take profit is over here. I'm now risking 17 to make 23. But I'm already, I don't know, 60 pips in profit, let's say. Then there's no reason to keep the trade open. What? Because you're trying to make an extra 20 bucks on a trade that's worth 60? Weird logic. So that is the scenario where, and you're going to get this wrong from time to time. I mean, I still get it wrong from time to time. That's okay. But just think consistency. Try to think like, what is the better choice? What is my risk versus reward ratio in every single decision I make? What is probably going to be more consistent? And that is how you decide when to close a trade. Or you're in that position and there's a news announcement, it developed a little longer than you thought, and there's a news announcement in 20 minutes. It doesn't matter if it's with or without you. If you're not sure, just close the trade, take the profit, take the money, and just watch everybody else lose money. Good fun. Get some popcorn. Right? And don't think about that the bad way. It's a null-sum game. Whenever you win, it means somebody else lost. That's the way this market works. All right? So applying it all to trade. We did the technical analysis, right? We did the trend line support, resistance, pop. Then we put in our indicators. We read the market out of that. We confirmed possible entry points out of this. We then determined our ratios and our lot sizes based on the entry points to make sure that they're the correct ratios. And we calculated our lot size based on our risk management or strategy and how much percentage risk we're taking per trade. Now, obviously, more advanced strategies have different risk percentages based on what type of currency it is or commodity or stock. This is all applicable to all things, by the way. Or perhaps for some of you, you like to go nuts. You do 10% risk. Don't. But okay. And we planned ahead for multiple scenarios. What if there is, a news announcement? We looked ahead. We looked at the timeline, and we looked at different ways to do our trade management. So that in sum is everything we did today. And it's a bit longer than I wanted it to, but we got there in the end. So hopefully that recaps it a little bit for you. And you get a good idea on all of this. Now, for the ones that are on YouTube, thank you for listening today. I hope you learned something. I hope some of this made sense. And if you thought, super, but I want to do more specific things, no problem. On LegacyFX on YouTube, just type in LegacyFX on YouTube. You'll find separate segments like technical analysis, like fundamental analysis, like risk management. They're all separate videos that I do a full hour on, more in detail. Feel free to look at those. And thank you for watching, and hope to see you on one of the webinars. As for the people on the webinar, now I can stop talking, and now you guys can start talking. This is my favorite part. First, I'm going to have a sip of tea. Wayne, you nailed it. Question number 1. Wayne says, how do you set your account to run off of a percentage of account balance as opposed to a static lot size, or are you calculating it manually? Yeah, Wayne, I am calculating it every single trade manually. I have a fixed percentage that I want in certain scenarios, right? So on majors and minors, because for me, they're roughly the same. If with the trend, I take, 4% risk. If against the trend, I take 2% risk. If I am confident about a trade, maybe 5%. If I have okay, I'll take a punt on this one, I'll take 2.5 or 2%. And I just calculate my lot size based on that. Because I know where my entry is going to be. I know where my stop loss is going to be. Like I said, I don't really care what my take profit is going to be. I just want to make sure that it's a ratio that's achievable. If that answer is correct, calculate the lot size, open the trade, walk away. So yes, manually, in a long-winded way. You have more questions? Fire away. Good. Can you elaborate in short the pivot levels and S1, S2? I'm sorry, wait, what do you mean exactly by S1 and S2? Call me stupid, it's light. Oh, the chart indicator, right. Sorry. Right. So, right. Let's start here. Let's start at the start here because the pivot levels. So there's actually an indicator. Where is it? Bill Williams made one. Fractals. Bloop. There's your pivot levels. Now, obviously, it's literally just turning points, right? But the way that you calculate them ahead of time, instead of like this, which just tells you where they turned. Well, I can see that on my blind eye. I don't really need that. Is by literally just taking the average angle that the market moves in to find out where the nearest resistance is for that, right? So in this case, let's take a week, like we did. And I literally just looked, we're going down. So since we started going down, what is the average angle down? They're matching, right? So the next pivot level from there is going to be wherever this line hits, but let's put that aside. Let's go up first. So since that started is from here to here, that goes up like this. That actually corresponds with this one. So out of that, I know that this is where the pivot level was because this is where it turned. Very simple. So by doing this, I can factor in that where it hits this line, that's where most likely where it will turn because there's the resistance, right? So based on that, I know that this is where my pending order goes, right? And I already calculated the downside. So let me take these two out, the original ones. Oh, bugger. There you go. And then put this one in from there. So out of those two, if I extrapolate that, whoops, I moved it a little bit. Right? You now know like, okay, so why do I calculate it here? Well, basically I base that off technical analysis when you look at resistance and support, because usually a market will pivot at support and resistances. Now, when it is Friday, you will look at the weekly resistance because you want to know where the week ends. Market closure, same as with price action, you want to have a closed candle. You can't make a decision until it's closed. Same with day. Day in this case is blue. So if at the end of the day, I'm looking at a potential trade, I want to know where it closes on the day chart because then it becomes relevant. If this one would close, let's say at the end of the day above this line, full body, right? This was the pivot point, obviously, but then it will obviously go here. So then I can expect a pivot point either here or here. And then obviously as the trade develops, you look at strength development and everything else, which is where the indicators come in. Now I'm not going to go into the indicators too specific, Wayne. I made a webinar on the indicator specifically explaining how the calculations on the indicators work, the settings and everything else. But if you come any one setting, any one indicator, doesn't matter which one. It could be moving averages, Fibonacci, Bollinger Bands, MACD, RSI, stochastic, triple exponential moving average, derivatives. It doesn't matter. There's not one indicator that tells you everything because they all have false signals and they work with past data, but they will help you try to identify development of patterns that have happened before, and based on that extrapolates that data. So the way you read that is once you've decided from the chart telling you what's going on. Like here, I see a pivot point, right? If this closes green, then we have a potential pivot point here. How do we know this? Well, here we have the MACD where the signal line crossed in over the zero line into the volume and the volume flipped from sell to buy. Here we have an RSI that's actually bending off the 50 that came down from the oversold, so probably wants to push to the 80. And we have here a stochastic where the signal line just crossed outside of the main line, which means that it was probably going to make a swing, which is exactly what it's doing right now, and then pull back and smash into the top, right? So based on that, we know that this is not going to be like a long run. This one will probably tip this at best and then pull back down and then do this. Because simply we know that this is too high and this doesn't have the range to go all the way up. It would have to come down to make the full range up again. Now that's not written in stone because you know that sometimes you will see an RSI like stuck to the top here and just flatline. That's usually fundamental. There's a fundamental reason why it does that. It doesn't do that because market sentiment, sorry. I hope that answers your question in a little bit of a simple way. Don't worry, everybody else. I'm going to get to all your questions. Okay. Yehi. Yayi, sorry. Sometimes I open or not open a trade, but I predict the direction of the market with good probability, but I still fear to hold or open that trade. Is there any solution about that? So this is more like a trading psychology kind of thing. The problem with that is it's the same as trading a demo account all the time. Like you get this confidence that you know how to trade, and then you go to a live trade and you think like, well, I did right on the demo trade. But the problem is you did without any risk, any real risk that you can feel. And it's like riding a bike. You have to be able to fall on your face and eat some dirt from time to time to understand that this is not the way you ride the bike. And it's like you learn it and you get comfortable with it. This is why you need to understand trading is not about psychology. Anybody that keeps hammering on about like, because these are what is those self-proclaimed gurus that I follow at the start as well. Like trading psychology is everything. As long as you have a good mindset and the right mindset, you'll do great. No, that is the dumbest shit I've ever heard. It has nothing to do with that. If you trade with a strategy and if you trade with a system, you need to be like the Delta works in the Netherlands, if you're familiar with them. It's a big, slow system that stops the water coming in, but it's based on an operated AI. So think about it like this. You need to be a trading robot, but with human intervention capabilities in order to judge the market as it goes, right? So how to get rid of that solution is literally just start on live trading by calculating percentage and working out the system, pull out the numbers to see that it works, to understand that it works that way. Because a lot of the time it doesn't feel right to us as the way our human brain works. We don't understand percentages. Our brain does not comprehend a percentage system. It understands fixed numbers, like that's very visual in our head. But a percentage curve, unless you're a little bit more into math, where you see paraboles and hyperboles just developing as pictures, for most of us, it's a percentage. It's like, yeah, but I have an idea, but it's like, right? There's no real trick except for maybe find somebody to hold your hand a little bit at the start to explain to you why would you make this decision here, why would you make that decision there, and help you like guide. But quite honestly, in most cases, the best learning curve is literally just running face first into the wall. Consider it this way. The money you lose in your earlier accounts is basically lesson money, like you would go to a college or school to learn to do it right. Because even if you're told every single correct way, you could follow somebody like Anton Kuhl, who used to be a trader for Goldman Sachs, right? He had a tutoring, he had a college thing for traders. Like even when you tell people from a professional point of view, like an actual professional point of view, like where you trade other people's money, even if you give them all the tools that you had, that you made you successful at Goldman Sachs, they'll still screw it up. So it's literally like hold your hand a little bit and you have to learn from your mistakes. As long as you have the willingness to learn from the mistakes that you are going to bound to stumble into and have the right expectations, please set the right expectations for yourself. Trading is not a get rich quick scheme. It's not, I'm going to put $1,000 in and 5 years of trading, I'm going to be a multi-millionaire. I'm not saying it hasn't happened. It has, but the risk you have to take to make that happen is worse than going to a casino and throw everything on black and just do that all in 50 times in a row and hope that you win all 50. There is a possibility that that happens, but it's highly unlikely. Now, the feeling that you get is the other side, where you do predict the market, you don't open the trade, and then you see that it does exactly what you thought it would do. How do you feel left behind? Yeah, but that's because you do that to yourself. You're like, God damn it, I wish I taken that trade. And then the next time that you do decide to pull the trigger and the trade doesn't go the way that you think it is, it feels double bad because you basically shot yourself in the foot. If you take every single trade that you decide with proper risk management, watch my risk management video. I explain to you exactly how the percentages work there. But basically, you end up with a 40% win rate is a profitable account. You don't need 70, 80% win rate. Good loss control and good risk management is way more important than anything else. You could literally flip a coin and open trades. I hope that explains it a little bit. It's fine, Wayne. Don't worry about it. At which point would you cancel the limit order? Would you say based on your estimated calculation how many days it would take to get to the open limit position? Yeah. So different factors, right? So in this case, I know that this trade, what were we in? Day trade. So following that line, this should be there in about 30 days. So about the end of the month, it should be there. Now it could accelerate or could decelerate, but a few days before that pending order is there. Now let's say, okay, so let's make this trade here. This trade should be there in a few days, like 4 days. But we have Friday tomorrow. And I don't want to have a trade open and then go in the closure of the weekend and have a gap opening that might, if my stop loss is then this, right? Have a gap opening here, hit my stop loss, and then just go here. Like that would suck. So in that case, I would say, okay, tomorrow I close the trade. But if I do it on Monday, I would just say, okay, if it takes 4 days to get there, closure on Friday. If it should take 2 days to get there, I will review the trade manually on Wednesday. Did anything change in the market? Would I reassess my trade? Do I move it a little bit? Or do I delete it manually? Right, so it's different per range, it's different per product. Like if you're in exotic pairs and you do pending orders, they're way more volatile, right? Like South African Rand versus US dollar. Like there's way more daily movement. So there I would probably say if by the end of the day it hasn't hit my day trade, I'll reassess tomorrow. I hope that makes sense. Thanks. Really enjoy your presentation. Okay, well, I'm very glad you're liking it, Wayne. I hope you can follow it because it's quite a bit actually today. I hope everybody else also feels the same way, by the way. Oh, wow. Okay, well, that's the bottom. All right. So anybody else have any more questions? I know we ran over the time a little bit, but if anybody has any questions, please feel free. And remember, this is a recording. You will get it. It will be on LegacyFX's YouTube page in a few days. You can go through it again. Our next webinar for LegacyFX, what do we plan? I think next month. Yeah, they only planned in one this month. That has to do partially with me going abroad the second half of the month. But definitely next month we're going to have more again. I don't know what the topics are going to be yet. That reminds me. For those that are still listening, generally speaking, after I close the webinar, it automatically sends a survey thing. It's anonymous, but it allows you to do two things. One, give feedback on how I present and what you thought about the presentation, and et cetera, et cetera, et cetera. And feel free to say whatever you want. You're not going to hurt my feelings. I always like positive reinforcement though. But it also gives you an opportunity to give some suggestions. So if everybody has like certain suggestions they want to see, like certain topics, like I want to see Fibonacci retracement, it doesn't have to be a full hour presentation we've agreed on. So, it can be smaller topics as well. There we're going to see an opportunity for you to just say like, look, I really would like to see a webinar about price action, which we already did, but just as an example. If multiple people suggest something like that, then I will be able to sit down with the guys at LegacyFX and just say like, look, this is the feedback we're getting. Do you want me to make a webinar for that? So it's really in your power. Otherwise, I just decide what the webinars are, really. Okay, hypothetical. What if you want to open a trade by 1 hour time frame after a top-down analysis? Should I enter and exit by period using the example you used on? Let me join late. Okay. So yeah, so when you do a top-down analysis on your US dollar, if you generally what you do is you execute the trade and close the trade on the same time frame, but you can do some management in the day. Because one of the bad things that we have the tendency is to look at an hour and then just sit at the computer and just stare at it. Nothing's going to happen. You calculated your trade. That's what should happen over the next few hours. Why the hell are you staring at a screen? And this is something Warren Buffett said. I'm pretty sure most people know who he is. Like one of the things is that you open the trade on Monday, you expected it to be somewhere on Friday. You don't look at it during the weekend. So why are you looking at it during the week? You don't need to monitor it 24/7. What I used to do in the morning, I would set up my trades. I have some trading, obviously during the day, there might be one or two. But then once the trade is open, I really didn't care much. I had my trailing top calculated and set up, and I would just have some reminders on when a news announcements are in case I need to intervene a little bit and do some minor adjustments, or maybe I want to secure the trade, so I remove the stop loss and put a counter hedge in on the same pair at the same lot size, just to ride out the volatility, and then open the trade again. Right, but that's more advanced. But like in general, you open the trade, you set your stop loss, you set your take profit, you set a trailing stop, you forget you even have it. But yeah, execute on the smallest time frame that you calculated, and please don't do calculation on weekday, 4 hour, 30 minutes, 15 minutes, and then open on 5, because then you're gonna have so many lines in your system that you literally can't read what you're looking at. Do 3 at best. So if you do a week and you want to trade on 5 minutes, do week, 1 hour, 5 minutes, right? So just skip. But I generally do an hour or 4 hours, depending on the pair. Like pound yen, I used to always do on 4 hours because it's too volatile on an hour. Used to be, at least. Nowadays it's kind of flat, but yeah, I would probably micromanage in like 4 hours or a day. And just take a look at it. No, yeah, in the morning and in the evening. During the day, I don't really care what it does because I should have factored that in. Now, if you're trading in a time frame of, let's say, 6 hours, right? Or let's say within 24 hours, a day trade, right? Then the expectation is also that you're trading for 24 hours and that you're not at work, right? Because that doesn't work. Because then again, you need to do what I said, the passive, the lazy way of being able to smoke a cigar on the beach and not care, is you do your calculations pre-opening, open the trade, set the trailing stop, close the computer, walk away, look back when it's either green or red. Or look on Friday in case it hasn't closed yet. That is the best way, and it also helps with your psychology that you had. It learns you to let go. Yeah, what you're explaining is basically if the swing happens and you want to move your stop loss, but maintain that you don't lose any profit, what you do is you put up a counter hedge. But this is a little bit more advanced, and it differs. It depends on what news announcement it is. And again, you should have planned ahead for economic events. Unless it is an out of the blue statement by Joe Geriatric Biden or something on US dollar, where he mispronounces a country again or something, or does some weird ass analogy that goes nowhere, and let's say the market reacts to that. Okay. Yeah, those are inconvenient things that sometimes happen. But if your trade is established with my system, you should have a trailing stop active. So it doesn't matter. Now, if the trade is just open and that happens, yeah, it just sucks. If you happen to be available to intervene, you just close the trade to, reduce the amount of damage you're going to take. But otherwise, you have a stop loss, which again is should only be about 3% of your account. So, if you use a ratio of 1 to 3 on average, or 1 to 2, because it's not an ideal world, but let's say 1 to 2, one winning trade, like you saw what I did the other day, what we did earlier, we calculated 3% risk, but it was a 12% profit. That means that if that one trade you lose and you win the next one, well, let's say you lose 3 in a row and then win one, the one profit overtakes 3 losses. Ergo, you only need to win 40% at a time in order to have a profitable account with a proper risk management. Hashtag math is great. But yeah, if you want to hold breath while holding the trade while it's going backwards, you open what is called a hedge. So same pair, same lot size, opposite direction. This only basically pauses your trade because you're not gaining or losing at the same time. The problem is, when do you close the hedge? Because it will cost you money. And you now need to cover the loss of the hedge. Because generally the idea is you open the hedge at some point, it goes against your trade, then it pulls all the way back to the entry point of the hedge, you close the hedge, and then it should continue onwards to the original trade. That barely ever happens. You're usually going to cost you a little bit on the hedge because you're going to close it a little bit too early or a little bit too late. Barely ever you're going to close it at the perfect time. Oh yeah, that is the answer. No, I hope that makes sense. Anybody else with any questions or feedback or anything randomly out there? So the question here is, technically, can currency strength, a calculator for currency strength, help with my entry of choosing pairs? Yeah, but it's just another indicator. It just tells you how strong is the US dollar relative to all other pairs, let's say. I know what you mean. So let's say the US dollar is really, really strong today and the Swiss franc is very, very weak. That would indicate that today you should be buying US dollar versus CHF, right? It should be a buy. But that doesn't change the big picture. If you look at pairs over an entirety of a year and then break that up in quarters, so Q1, 2, 3, and 4, you will see that their behavior is not that sporadic. Big traders, I'll go back to Anton Kriele and Goldman Sachs, they don't look at what it does this week. They don't even look at what it does this month. They look at like the next 6 months, Q1, 2, 3, and 4, specifically. Roughly, what should it do? They couldn't care less if 2 days it's up or down. Even like today with that Euro GBP, like this, like they could not care less. It's all factored in, so it doesn't matter. Yeah, no, Sean, you don't put a trailing stop on the hedge, because what happens then is your hedge goes into profit while let's say you have a buy and it's going into a selling opportunity. You open a hedge as a sell, right? So you open a sell to your buy. You now put a trailing stop on your hedge. That means that the second that it starts to pull back, you take some profit on your sell hedge while your buy is still in loss. But now you start with a bigger loss than you originally opened the hedge. Now you made that in profit, but if now the market pulls back into the selling opportunity, right? Your hedge is no longer there. You took a little bit of profit to cover that little gap. Now you have a weird gap. Now if you open another hedge, let's say a second hedge now, you now have a gap loss that you have to paste on top of your take profit somewhere somehow. So a hedge literally is the moment you open it is also the place where you're going to close it. It is not to make you money. It is literally to pause the trade. Nothing else. I don't know. A lot of people have the idea, well, I can make a little profit on this hedge and then go back into buy profit. That's a terrible idea. Usually that doesn't work out. I mean, sometimes it will, but my golden rule is I care for consistency. I don't care for anything else. So if the more consistent thing is doing it one way, even though that means that sometimes I go out at zero, so be it. At the end of the year, my account exists, and for some people it doesn't. Right? And I make profit. Usually what I say as expectation is like, just factor in that 10 months you're going to be, if you do it good, right? 10 months you're half profit and 2 months you write off as a loss. If you have a 40% win rate, which is basically the starting point, with a proper risk management that you systematically follow and not screw around with, and let the trades run, then that should be the result. Now, obviously, you can do much better. When you get more experience, obviously, you're not going to have 2 months loss. You're going to have maybe 2 weeks of losses combined. And the rest is all profitable ones. And because you're working with a percentage system, you grow exponentially. Ergo, and don't think like 300-400% a year. That's great when you're a small account. That's possible. If you have $1,000, you can do like the first year, you can do 50%. Easy. I showed you how to make 12% in one trade in like 6 hours with 3% risk. It's really not that hard. But when you start getting to 6 figures, try getting 12% return on a 6-figure trade. It's not that easy. So you do less percentage, but then your scenario is more like, okay, by the end of the year, if I leave it in the bank, it's going to cost me money. Let's say in a good scenario, I get 3.6% interest rate in the golden days, right? I want to beat inflation. That's basically my target. And I want to build up for my pension. So in other words, I want to do 10% a year. That's good. Anything over 10%, awesome. But my target is 10. It depends on where your entry point is, Yai. If let's take this scenario. Let's take the euro US dollar again. Let's go back to this guy, where this chart. So in a day, so let's say we're over here, right? This green, the last green candle. So let's go to an hour. That's the last one. It's over here. In this case, you're closer to a stop loss that is a day than an hour. So even if your stop loss on an hour would say this, it is also what it would say on a day, right? On a day, you would do the same thing. Now, if I am over here, where did the line go? There. Now, let's say I'm over here and I want to take a sell here because I saw it pull up a little bit. You can put the stop loss here based on the idea that your take profit is also going to be in the range of an hourly range. Also understanding that if the market changes in the day, it has range till here, because that's the first daily resistance point. Right? Makes sense? But you should then trade here. But you prefer to, in this case, if that would be the scenario, you will also have your hourly trend right there. Well, let's say you didn't have that one yet, because we're talking about these three right there. So let's say you have this. Then your calculation would be, if I go in here, my stop loss needs to be outside of this line and outside of the trend. So doing a little bit of angling, like it would hit here. So this would be fine. It would have to break both lines to get there in an hourly. That would not be relevant for the day. I hope that makes sense, what I just said. Whoop. Okay. Sean, would you recommend candlestick patterns to enter? Yeah, price action is definitely something stable. There is a lot of what's the word I'm looking for? Validity to candlestick patterns, price action. I actually did a webinar on it a few weeks ago. Go to YouTube, type in LegacyFX, you'll see price action. I did a webinar twice, I think, for them on it. Where I discussed like morning stars and dojis and engulfing candles and false signals and all that kind of stuff. It is definitely something to use, but you need to understand, if you're trading on a day or a week, they're very, very strong and meaningful. If you're trading on 5 minutes, they mean very little, because 5 minutes doesn't really have a rule. It roughly has a rule, but a rule within all the other factors above them. So the lower in the time frame you go, the less adherent to rulings it is, because the bigger ones overrule, and they're the big picture. That's where it's going. Right? So the rest just follows. I hope that one made sense. But short answer, yes. Wait for confirmed price action of your choosing. Let's say it's I don't know, rising star. You have all your indicators, you have all your technical analysis, everything is telling you a buy, and then you have a confirmed 1 hour pattern of a rising star. Feel free to open the trade after the third candle has closed. So then you literally open on the moment the new candle starts, if it is a confirmed price action. Right, we kind of overshot by, I don't know, quite a bit. It's okay though. But yeah, I'm gonna wrap it up here. So for everybody that came, once again, thank you so much for coming today. Appreciate it. I love the Q&A, good Q&A. I hope it helped you guys. I hope you all learned something out of it. Remember the survey, I would really appreciate it, especially your feedback and suggestions to get some topics off the ground that you guys want to see, and girls, and whatever you identify as. And hope to see you in the next webinar. For me, thank you all, and stay safe. Happy trading. Cheers.